Our next session here is going to be about the American Monetary Reform Act. The Legislative Action Committee has been working hard over the last year, fully reviewing and updating the National Emergency Employment Defense Act of 2011, the NEED Act, to the American Monetary Reform Act of 2022, or AMRA. The LAC presented AMRA to the board for review on May 21st, and on June 11th, the board met, discussed, and approved it unanimously. We ask that all of our members and subscribers read the proposed legislation. While this is not necessarily AFJM's last update or version of AMRA, this version was fully reviewed and updated. We look forward to educating on and advocating for AMRA in year 5. And I will now turn it over to John Howell to walk us through the changes that were made.
Well, thank you, Tabitha. And the committee was Tom Wilda chaired the committee. And on the committee was Debbie Hillman, Jan Frieswick, Lucille Howard. I hope I'm not missing anybody. But in any case, that's the group that worked on this. So along the way of our update, the act, as you know, was renamed the American Monetary Reform Act. The purpose of the updating was simply that. It was not to change its substance. The part of the act that needed updating most was the findings, which introduces the act and lays out the problems the act will solve. Those had changed somewhat between 2011, when the NEED Act was first introduced, and the present. None of the monetary reform mechanics have been changed from the original NEED Act. As the NEED Act did before it, AMRA lays out the mechanisms through which the 3 monetary reform goals of the Alliance are to be achieved. So in going through the Act briefly, I will point out how these 3 goals are achieved and also point out the changes between the NEED Act and AMRA, most of which are in the findings section. Note that what you will be looking at, only the portions in highlighted in yellow have been changed between the two acts. So let me go to screen sharing to bring up these 2 acts side by side. Okay, so you're looking here at the NEED Act. And the NEED Act, of course, was introduced after the collapse of 2008, and it focused on creating a full employment economy because unemployment was high at that time. So AMRA broadens the approach here from that. Let me see if I can get rid of this. Okay, that's good. Okay, so AMRA now broadens the rationale, stating that its purpose is the creation of a more equal and just economy in which all have a right to employment and a livable income as a matter of national economic policy, and to provide debt-free public investment in physical and social infrastructure. Now, going on to the findings section, again, in the NEED Act, which you see here, it started focusing on unemployment and the conditions of the recession. So we've changed that now, going to the American Monetary Reform Act. And here, the findings start with more contemporary problems of healthcare and climate change. And then it goes on to address the economic issues, including jobs, extreme wealth inequalities, and the persistence of poverty. So I'm not going to dwell further on this section. Since this version of the findings section was initially drafted, actually conditions have changed again, for instance, with regard to interest rates currently being charged. What this means is that updating of this section will be a continuous process. By the time it gets into the congressional mill, more changes will be appropriate and will be written in. But because the actual mechanics of the proposed reform will not, as far as we can see, change, there's no reason to hold back from using AMRA as it stands now for our advocacy purposes. Let's go back to on the NEAT Act now. There was a significant change in the wording of Section 2. Let's go down to find that. Yes. No, I want to be I'm in the wrong place here. Okay, let's go down here to NEAT Act 174. Okay, and this has to do with purposes because the NEAT Act essentially claimed its purpose was to maintain long-run growth, as you can see here. Okay. And to promote maximum employment. Well, the idea of maximum employment becomes more problematic in an era of robots, which is, of course, why the ideas of a citizen's dividend or universal basic income currently receive attention. And perpetual growth is simply incompatible with living on a finite planet. So in AMRA, we go to 217. Let's see, here we are, purposes. So what we have written here, and you can see this down here in yellow, what AMRA says that its purpose is to increase citizens' quality of life so as to promote effectively the goals of a steady value for the currency, satisfactory and sufficient employment, and long-term interest rates that revolve around the cost of providing savings and loan services. It also makes clear the intent of the Act to authorize Congress to regulate all forms of money, including electronic money. Now let's go on to the next section, which is a section called definitions. And here there's only one change that we made. And that is the name of the bureau to be formed in Treasury from elements of the Federal Reserve. The NEAT Act called it the Bureau of the Federal Reserve. But that name seems inappropriate since reserves are part of the old system, not what the Act proposes. In AMRA, it's called a monetary bureau, and that's what you see here. And that means that this Act really calls for two agencies within Treasury: the monetary authority to make decisions as to how much new money the government is to issue, and the monetary bureau, which is just to manage the processes of analysis and regulation which may be called for and which had previously been done by the Fed. Now, the next section, section 4, is called Coordination with Other Law. This is an important section. It's not changed from the NEAT Act. And what it says is that if this act is inconsistent with previous law, then this act shall supersede previous law, but only to the extent of the inconsistency. It also directs the Secretary of the Treasury to implement such technical and conforming amendments as the monetary authority may recommend, making any additional revisions of existing law that might be needed, and or to recommend legislation needed to clarify and implement provisions of this act. Now that brings us to Title I, which is the origination of United States money. AMRA specifies that the authority to create money within the United States shall hereafter reside exclusively with the federal government, and that this money will be known as United States money. It gives guidelines as to the actual production of bills and provides for gradual phasing out of Federal Reserve notes. It specifies the United States money in all its forms as coins, currency, and electronic money are legal tender. Now, we did make an adjustment in this section to include electronic money. Now, section 1, I'm going to skip down here to section 106, which is 428. 106, 428. Okay. Yeah. So this, see where, wait a minute. Okay, I need to be on 428. That's where I need to be. Okay, section 106 specifies that creation of U.S. money will take place in lieu of borrowing. So this is a prohibition against borrowing, but it applies only to the executive branch, not the Congress. And that's because the Constitution gives Congress the authority to borrow money. Now, this particular title that we're in, Title I, ends down here. It ends directing the Secretary of Treasury to pay off government debts as they become due. That's what you have up here. And for the comptroller of the currency to audit the system. So that brings us to Title II, which is the entry of United States money into circulation. What this section does is to specify the circumstances under which the Secretary can create new money. And that is generally because of acts of Congress. And also for the payment of federal debt and some other specifications of this act. Then we go on to Title III, and this is the reconstruction of the Federal Reserve System. The Section 301 simply, let's see, yeah. Okay, as you can see right here, Section 301 directs the Secretary to purchase all assets of the Federal Reserve System from the commercial banks which own them, and to return to commercial banks the reserves they held at the Fed. That's what 301 says. 302 establishes the monetary authority. It's a fairly long section because it specifies its membership, its operation, and its governing principles. Now, with regard to governing principles, we have made a change that's consistent with the change up in the findings section, pointing out that the principles now shall be commensurate with the economy's long-run potential to increase citizens' quality of life and promote effectively the goals of a steady value of the currency, satisfactory and sufficient employment. Now we go on to section 303. 633, here it is, okay. And this now is the establishment of the Monetary Bureau. So we've had the establishment of the Monetary Authority. Here's the establishment of the Monetary Bureau. And its functions, down here on, let's see, 633, it's established here. Its functions are described here. 76, here they are, duties. Its duties are to administer under the direction of the Secretary the origination and entry into circulation of the United States money, subject to limitations established by the monetary authority. Okay, and this again repeats this statement here about the fractional creation of money through lending, sometimes referred to as fractional reserve banking. And we changed this in part thanks to input from the Research Committee, Research and Policy Committee. Going down to section 304, what this says is simply that the Secretary is supposed to try to forecast disbursement requirements and to keep the government authorities and public informed and to maintain a research capacity to make forecasting possible. Section 305, called Lender of Last Resort and Emergency Procedures, sets up emergency procedures should there be reasons for the monetary authority to authorize money creation and lending to anything beyond those things listed in Title II. These emergency procedures represent a major hurdle to any bailing out of private corporations, such as banks, such as was done in 2008. Now, Section 306 goes on. And this simply says that all commitments made by the Fed prior to AMRA becoming law will be honored. It provides for transfer of employees from the current Fed into the Monetary Bureau as needed to be determined jointly by the Secretary and the Board of Governors of the Fed. Now, this moves us down into Title IV. It's called Transitional Arrangements. It's a big and important section. The first part of it, 401, simply provides more details for the transition from Federal Reserve notes to United States money. But 402 gets interesting. 402 says replacing fractional reserve banking with the lending of United States money. Now, what this specifies is that banks can offer two types of accounts. One, deposits, as is indicated here. And this is later to be defined as transition accounts. So deposits and transition accounts are the same thing. And the second type, transaction accounts. Thank you. Transaction accounts. And the second kind of account is a fixed term account, which is in effect a savings or investment account. So the transaction accounts are limited by the following provisions, which you see here. No interest charges are involved. And two of the deposits are held in bailment, not to be treated as an asset of the depository institution or as a source of credit. Now, fixed term accounts let's see, where are we here? Fixed term accounts refer, here they are. Yeah, exception for long-term savings not subject to deposit insurance. And later, these are referred to as fixed-term accounts. So these fixed-term accounts are not subject to these provisions. They are not held in bailment, and interest may be involved. Monies in fixed-term accounts are not considered deposits for purposes of the FDIC Act or the Federal Credit Union Act. That is to say, they are not federally insured. The fixed term accounts are where investment money will go into, instead of into treasuries. Unlike treasuries, these accounts, however, will not be totally risk-free. The only risk-free place to put money is into transaction accounts, which earn no interest. Now we go down to 917 here. And so this section continues with the specification that bank loans extended under the old system will become liabilities of the depository institution to the federal government upon implementation of AMRA. What that means is that money, which at the time that AMRA is enacted becomes U.S. money, and which is being returned now to banks as repayment of loans, will no longer disappear. This money will go into a revolving fund, which is specified here, within the Treasury Department. But the banks keep the interest payments. It's 930, it's down here. The banks keep the interest payments on these loans. Now, subsection A of 402, found 44 here, concludes by charging the monetary authority with the responsibility of establishing and publishing accounting rules for the conversion of all bank credit in circulation into United States legal tender money, and to prescribe new lending and accounting regulations for transaction accounts and fixed term accounts. I'll go down here a little farther. Here, we define transaction accounts, repeating really what was in section 402A in slightly different words. So back in the Need Act momentarily, I'm going to go back to the Need Act here and go all the way down to 916 if I can here quickly. Here, okay. So the Need Act specified that $1 of United States money shall be on hand or in a federal government account for each dollar in a transaction account. Well, the Need Act failed to define government accounts or specify anything about them. The wording itself seemed to reflect the idea of having reserves backing up a transaction accounts. What is essential here is that transaction accounts are monitored by the Monetary Bureau as a measure of the money supply. The wording has now been changed in AMRA to read as follows. Here you see it. every dollar of United States money in a transaction account shall be recorded in a suitable ledger managed by the Monetary Bureau in accord with procedures it has developed and it develops as part of Section 303. Going down, let's see, where are we? Oh, yes. This section also specifies that financial institutions holding deposits as transaction accounts may charge a fee for this service. And then the final two subsections here these sections encourage profit-making lending activity by banking institutions, but specify that these institutions may only loan pre-existing money which they have earned or borrowed. That is to say, repeating again that fractional reserve banking is ended. Now, this takes us down to, Section 403 establishes in the Department of Treasury the Federal Reserve Fund. And this is where amounts received from depository institutions under terms specified in Section 402A2 of this Act shall be deposited and made available for relending to banking institutions and for other purposes. These amounts are repayments of loans made by banks prior to the time AMRA takes effect. Money from this fund can be lent to banking institutions, which might be needed during the transition, and can also be borrowed by the government in case of national emergency. This specifies the national emergency. And now this brings us down to Title V, and this title basically suggests spending, and it only suggests, only advisory, suggests spending for infrastructure, education, Social Security as needed, a citizen's dividend, universal health care, responding to economic dislocations arising from the pandemic, and interest-free lending to local government entities. These recommendations are advisory only, but Section 402 does say something that's more than advisory. It's a limit on financing fees. So this sets a limit of 8% on interest rates to be charged by financial institutions and with interest not to exceed principal, except on mortgages. Section 503 is the authority of the FDIC, and it directs the Board of Directors of the FDIC to study and make recommendations for any appropriate changes in its operation. And of course, what we know is FDIC won't be needed after AMRA is passed. And 504 is an important one. This is the one that says 25% of the new money created each year goes to states on a per capita basis for infrastructure spending. So that concludes my brief run through of this whole thing. And I would just let you know that we did our best in the LAC. None of us have legal sort of experience here. So we did the best we could. We asked for input from various people and we're not able to get it. So we are interested in basically continuing this process. As Tabitha mentioned, this is an update, but it undoubtedly won't be the final one because of the continuing learning that we are all doing in this process and getting increasing clarity. So with that, let me turn it back to Tabitha. Thank you.